Hi, welcome to Remax of Boulder's podcast. I'm Duane Duggan, host of the show, and today we have Bill Humphrey with New Direction IRA. Bill's company has been helping people invest in real estate since 2003 using their IRA. So welcome, Bill. Thank you for being here today.
Thanks, Duane. Thanks for having me.
Why don't we kick off with you just telling us a little bit about what New Direction IRA is and how it got started?
Well, we are a self-directed IRA provider, which means that you get an IRA that you get to choose everything that happens in. So with self-direction, you're in charge. A lot of our clients are looking to buy something that they understand in their IRA, and that for a lot of people that's real estate, as you've discovered and your clients have discovered, that an investment is a great investment no matter where it is, whether it's in your IRA or not.
Okay.
The surprising thing with a self-directed IRA is that you're not limited to just stocks and bonds. The securities industry tends to want to make you think you are, but in reality, you're not. Whatever investment you want to make personally, you can probably make that same investment in your IRA.
Okay. When I first met you in 2003, you had just started the company, and now you're at 1.1 billion assets under your control, or people that had invested through their IRAs.
Right.
So
right.
Growing quite a lot over the years. That's what, 12 years or so that your company's been around?
Right, 12 years. It's actually the fastest growing segment of the retirement industry as a whole, self-directed IRAs.
Okay. And then when a lot of people call their financial planner or stockbroker, they ask if they can invest in real estate and through their IRA, and they usually get told no. Why do you think that is?
Well, surprisingly, or not, those companies typically are selling something. So the securities industry advisors that you might call, they can only talk about what they can sell. So with a self-directed IRA, and with the IRS looking at IRAs, they're not worried about what you're investing in, they're just worried about the IRA itself. So there are actually no rules about what you can't invest in other than two things, collectibles and life insurance.
Okay.
Other than that, any investment you've ever made in your entire life is probably one that your IRA can make as well.
Okay. Now, one of the things I've discovered, clients coming to me asking about this, they ask me about the new way that you can invest in real estate using your IRA, but it's been around for quite a long time, hasn't it?
Right, actually since 1975 when the IRAs were first introduced. The one change in 1995, I believe, was the Roth IRA. So
okay.
All IRAs that you've ever had, in fact even a health savings account, could be self-directed.
Okay, wow, that's interesting. Build up, if you don't actually have to use the money in your health savings account, you could actually eventually own real estate in your health savings account. That's kind of exciting. So now me personally, I always use up everything for body repairs and so on. Right, that's right. And so as far as in, we talked about investing in real estate per se, but there's actually a lot of other things relative to real estate you can invest in. Do you have some ideas there?
You know, we have clients that do all sorts of things. That probably direct ownership of real estate is the primary thing.
Okay.
The next thing might be lending to somebody else that's buying real estate. Maybe partnering with other people to go in to buy a bigger piece of real estate than your IRA can afford. Options, notes, financing, anything that you've ever done related to real estate, your IRA could do the same thing.
Okay, and there's a few rules that come along with that. It's like you can't have your IRA lend money to yourself to buy real estate. Is that correct?
Right. So
okay.
When the IRS set up IRAs in the first place, they made a deal. So you get to have this money set aside and not pay tax on it in exchange for leaving it over there and not getting any personal benefit from it while it's in there. So the IRS defines personal benefit as buying or selling, lending between you and your IRA and certain other people. But remember, this is investment money. You shouldn't be getting any kickback from it, any use of it. So if your IRA owns a condo in Maui, for example, you can't use it.
Can't use it. It has to be rented out.
Right.
Gotcha. Okay. Now, one of the calls I get a lot is somebody's got a 401k with their company. Can they invest in real estate, or are there separate rules for that?
You know, all of those company plans are unique because the company had somebody write them specifically for that company. So like the IBM plan, you can invest in all sorts of stuff, but it's only what IBM has allowed. And for most companies, that means it's only securities.
Okay.
So once you've changed jobs, for example, you move from IBM to HP, that gives you a window to roll those funds from your 401k into a self-directed IRA.
Okay. Well, it sounds like there's an alert going on out here, so maybe we have a special alert for
somebody's listening to
this and getting all excited about investing in real estate. So other than that, like if somebody did leave their job, you could roll over a 401k into a self-directed IRA.
Right.
So, and is it possible to also have a self-directed Roth IRA?
Absolutely.
Okay, so either way.
Any of those plans are all self-directed, depending on where you set up your IRA. So hopefully when you decide to self-direct, you come to New Direction, and we can help you, educate you about the different plan rules and how the process works.
Okay, fantastic. Well, since we've been talking mainly about investing in real estate, why don't we talk about how a transaction where you buy real estate using your IRA is a little bit different in the process than if you were just buying it personally.
Sure, sure. How long have you been here in Boulder?
I started selling real estate in '78, but came here in '74 to go to college.
Wow. So you've seen the market change quite a bit.
It's gone up and down quite a bit.
So one of the things that starts people thinking about self-direction, I think, is looking at a market like Boulder. What do you think the increase in the last 3 years has been in
I would say the last couple of years in some neighborhoods we're probably hitting 20% appreciation. But I look back to the things that I've owned since the late 70s, it's probably averaged about 10% a year, even though it's had ups and downs.
Right, right. So one of the things that excites people is discovering that, so they're in a market, like I remember I bought my first house in Boulder in '87. 4 years later, I was talking to a neighbor, and he was selling his, and had gone up 30% just in the past 2 years, I think, from that '89 to '91 time frame. And I thought, darn, I wish I could have bought another house, because you see all of the growth in the area, and you think, well, that's a good investment. But a lot of people look in their pocket and say, gosh darn, I don't have any money.
Right.
Well, the thing they don't think about is their retirement plan. So what their retirement plan is an account, and I like to call it a bucket that is owned by Uncle IRA. It's an important thing to separate you from your IRA. So that money is available to buy whatever investment you've decided, and when you see that great opportunity like a booming market, think about the money that's in that account and think about it as being able to make a purchase of whatever investment you decide. So when people are thinking, gee, I wish I could buy something, they may discover that, wait, my IRA can buy that. And it has to be for Uncle IRA, it's not for you personally to use, but all that appreciation and whatever is going to stay in the account and grow, because what you want your Uncle IRA to have when you retire is the most money.
Okay.
So how is it going to come from? So that money is in the bucket. The process of getting that money, cash, turned into an investment is the same process as any purchase, because there's a buyer, that's Uncle IRA. So when you're you're filling out a offer for your client who has an IRA, then Uncle IRA's name goes on it.
Okay.
Uncle IRA is the buyer. So for our accounts, it's a New Direction IRA for the benefit of Duane's client IRA. That actually goes on the title. We sign that document on behalf of the IRA because our job is the administrator or record keeper for the account. So we do all the signing, we just don't do any of the deciding. So we're only there to help somebody with the process, and they and you work out which property they want to buy. From that point, the money comes out of the IRA to go to closing, the rents come back into the IRA, property taxes come out, just like any investment. It's all happening in Uncle IRA's bucket.
Okay. And so Uncle IRA is the fictional character you've created, so
Right.
you can think of it as separate. So the contracting process, essentially the same as buying a house individually, other than Uncle IRA, in this example,
Right.
has got to be the one who signs the offer.
Right.
And then make any checks and that type of thing, right?
Right.
Okay. And so the next question in the process that's a little bit different that people ask me is, how can I finance it? Can I finance part of the purchase price when I buy in my IRA?
And that's a great question, and that's one of the things that's changed since 2003 when you first hobbled into one of our early presentations. I remember meeting Duane on crutches the very first
typical
time.
situation.
Some of that maintenance that's going on. But anyway, so the process itself, what can Uncle IRA afford? So like I was saying, my Uncle IRA back in 1991 didn't have much money, but now he's got a little more money, so how much money can he afford to buy? Well, you and I might think, oh, 20% down will do it, but Uncle Ira over the past 30 years has always put 100% down. So he buys 100 shares of IBM, he pays full price cash on the table to buy those shares. Well, since 2003, the whole lending industry has noticed that people that have been successful and had a lot of money in their IRA, so our average account size is about $85,000, but up to millions in IRAs.
Okay.
That money can go and buy whatever it can afford, and the people behind it often know pretty much a lot about what they're doing. So bankers have started to notice that people that have wealthy Uncle Iras might be good credit risks, so they've actually started lending to IRAs.
Okay.
Uncle Ira can't go to get a job,
Right.
unfortunately.
He doesn't work.
He doesn't work. Doesn't have a credit rating. So what's the bank gonna base its loan on? Well, banks are cautious, so typically we're seeing 35 to 40% down.
Okay.
And they also want to know a little about the person, because with any self-directed account, who's the decision maker? That account owner is.
Right.
So we're not there to say you shouldn't buy oceanfront property in Arizona. We're there to make sure the titling is appropriate. So it's up to the person to make every decision about it, including talking to the lender and convincing them that they know what they're doing to make Uncle Ira pay his bills.
Okay, and there's one unique characteristic about a loan to an IRA that a typical 1 to 4 unit Fannie Mae lender can't do, and that is the non-recourse feature of a loan.
Right. So Uncle Ira goes into a bank, asks the banker for a loan, and Uncle Ira has no credit rating, no history. So the tendency would be for Uncle Ira to turn out and call the account owner in and say, here, help me get this loan. Well, that's one of those transactions that's not allowed, because your Uncle Ira has to stand on his own to buy whatever it is he's buying. So your personal credit rating and your personal loan guarantee cannot be part of that transaction. So that's where the non-recourse, no recourse back to Uncle Ira's owner. So Uncle Ira has to get it all on his own. So
Okay.
that's where the 35% down usually comes from.
And then they also look at what's left in the IRA too after it's depleted its money for the down payment. They want to see that there's enough strength to cover any repair issues and such, because you can only contribute the maximum amount, and if the repair is big, like a roof, and there's only 4,000 left and the repair is 10,000, then that's a problem.
Right, exactly. So planning, that's a great point, is this is an investment and Uncle Ira has limited money. So when you're thinking about how much he can afford, make sure that you build in those expenses, repairs. Remember, there's rent coming in, hopefully, not always, as any landlord will tell you. There's not always a tenant there, and even if there is, they're not always paying their rent. So building in a cushion is a good idea.
Right. Well, I know there's been a lot of financial planners that try to talk their customers out of buying real estate in their IRA. Why don't we talk about some of the advantages of buying real estate in your IRA and how it's a little bit different than holding it individually?
So the big advantage is if you find a great deal, that great deal can make your Uncle Ira grow. So if you're not comfortable in the stock market, a lot of people aren't these days, and you're worried about CD rates of being measurable even with a magnifying glass, you can hardly see the interest coming in. But if you're looking for cash flow, a lot of people think real estate because of that cash flow from the tenant coming in. So that's one way. You've got money that might not be working now, might be just parked in cash somewhere. You're worried about inflation, you're worried about what's going on in the market. It gives you another avenue. So you can be a lender, you can be a real estate investor. It gives you another great investment opportunity with those funds.
Right.
And for a lot of our clients, that's what they've always done. In fact, when we first started, Catherine Wynn, my partner who co-founded New Direction, that's all she'd ever invested in, real estate. She'd seen it grow, she knew how it worked, she understands it. And her guy at the securities company said, oh, no, you can't do that. So that's where New Direction started, actually.
Well, one of the big advantages I see in, as far as owning it in your IRA for somebody is that when you do go to sell it, which is pretty much a normal transaction, but the difference is you just sell it and then you put the money in your account. You don't have to wait, like follow the 1031 exchange rules where you have only 45 days to find a property. You just put it back in your account and wait till the next one comes up, so, which is awesome, I think, because on the 1031 rules, I bought a property I didn't really want on day 45 several times in my life, so.
I've heard that story, yeah. You pick three and you never think that
Correct.
third one is gonna be the one you have to buy.
Right, and in today's market, sometimes it is pretty tough to find something within that 45-day time frame.
Right.
So you can just, the cool part about real estate though in your IRA is it just grows in value, all the rent coming in just goes into your IRA, and then when somebody does have rent coming in, they give it to you, right? And then it's held in their account, and then the client directs you where to invest that cash, right?
Right. So by default, it goes into the bank in cash. So the tenant, in most cases, will send the check directly to Uncle Ira's account with us. We put it in and we wait for instructions about what to do with it.
Okay. What about disadvantages? What kind of disadvantages pop into your head about?
Well, you know, with real estate, it's not something you can sell tomorrow, except
Right.
in this kind of market it might be. But generally, it's a long-term investment. So their transaction costs of buying it, their transaction costs of selling it, so it's not something necessarily that you want to buy short-term, although we have seen people successful with short-term. But there are higher transaction costs for real estate. Once you start getting towards retirement age, you're going to start wanting to take money out, although at that point a lot of our clients have found that there's cash coming in, so you can just take the cash out. But if you get to the end of the road and you want to take the money out, then you have the option of taking slices of the house or property out, or you can sell the house to somebody else and then have the cash back in there. So
Okay.
it requires a little more planning. And one of the interesting things that we talked about with financing is that the IRS, to make things fair for them, has a special rule and a special tax called unrelated business income tax.
Okay, you bet.
You bet. Right, so it surprises people because Uncle Ira can actually have to file a tax return. And what is that tax return tax? Is the earnings from the portion of that purchase that came from the debt financing. So for example, Uncle Ira has $50,000 and he borrows another $50,000 to buy a $100,000 property. Then half of that property is debt financed, at least to start with. And the profit from that, after all the normal depreciation and interest and tax expenses, is subject to tax, even for Uncle Ira.
Okay, that brings up another point, like depreciation doesn't carry through to you personally when it's owned by your IRA, which is a little bit different than what a normal person might be wondering about.
Right,
on
that's
depreciation.
one of the most popular questions is what
Right.
about depreciation? So remember, it's Uncle Ira buying the thing, it's not you.
Right.
So it's his depreciation. In fact, when he files a 990T, he uses it.
Gotcha.
But it's not your money, so you can't depreciate, it's not your asset. So-
Okay, well, let's move ahead in life a little bit, and what happens, like, let's say somebody wants to get the IRA or the house out of the IRA, or disperse it. Any issues there toward the end?
You know, planning again is important. So if you left the IRA to your 3 kids,
Mm-hmm.
equal portions could go to those 3 kids, or you could actually go in and say, okay, the oldest kid is going to get a certain portion, middle kid gets the property, and the younger kid gets all the cash.
Okay.
Up to you to decide, but it is one asset, so you can't split it up as easily as you could 100 shares of IBM.
Okay.
The other thing is, if you want to get it out, you call Duane and say, Duane, I want to sell this property. The same process of getting rid of it, selling it, it's just
And
a
then the
transaction.
proceeds just go back into the IRA, and then it goes accordingly.
Right.
And I thought of one other thing, as far as a question I get asked a lot, like we mentioned that you buy a ski area condo, you can't use it yourself, but what if you have your IRA buy the ski area condo, and then when you do retire, you eventually want to use it personally? Is there a way to do that?
You can get it out, and you
Okay.
can get it out by taking it in kind distributions out. So you can call us up and say, I want to take my ski condo out. We'll say, okay, what's it worth today? Go get an appraisal or evaluation of it. We'll issue you a 1099 with that value. Say it was worth $150,000, we'll give you the 1099 and the deed.
Okay?
At that point, you're going to have to deal with potential income taxes, assuming you have a traditional IRA.
Right, unless you had it in a Roth,
Unless
then
you
you
have
really
it in a
scored.
Roth, then you just take it and go
So-
home, and there's no tax due on it. So
Yeah. Wow, a lot to think about.
All of the stuff that goes along with retirement planning, same issues with self-directed IRAs. You need to know what your plan is, and what kind of assets are going to work best.
Okay, well, I think that probably covers it for today. I hope that most of our viewers actually have come up with more questions, and as we get some feedback, I would love to have you back to talk about some more specific things. So,
Well, thanks for
thank you,
having
Bill,
me.
for being here. Appreciate it.
Thanks.
This is RE/MAX Boulder Podcast. Hope you enjoyed it.